Hey Freedom Fighters, Rob Berger back with another video. This one talking about how to manage our finances and specifically our investments during the COVID-19 crisis. It's a question I've received a lot in comments to other YouTube videos and in email. And so I'm going to walk through some strategies, some ideas that you can think about as we're trying to navigate, let's be honest, uncharted waters. And I want to begin with my thoughts on kind of where we are in this crisis. I don't want to sound overly negative, but I also don't want to be unrealistic. And I try to get into that spot where I prepare for the worst, but hope for the best. And that's what I'm trying to do in our own finances and what we're going to talk about in today's video. Having said that, as I was preparing this video, I came across a news article. Let me show it to you on my screen. Dow declines as prices crash to below zero for first time ever. That's a pretty significant event. Now, part of it has to do with futures contracts in the oil market. And many are saying that actually, when you look longer term, the prices are much more, I guess, I'll say normal in air quotes, because I don't think anything about our economy or the price of anything, including oil, is normal. But at least not well below zero. Apparently, the short-term issue is storage, right? Where do we put all this oil that we're pumping out of the ground? Since not as many planes are flying and we're not driving our cars back and forth to work or across the country for a road trip, where do we put all this oil? So that's sort of the short-term problem that's caused prices to plummet. Longer term, they say, look, once we get over this sort of initial shock and things start to get back to kind of normal, whatever that's going to look like, activity picks back up, the oil market will stabilize. Now, will that happen exactly as the experts say it will, and when will it happen? I have no idea. I do believe that we are in, I tell people we're in a marathon, not a sprint. Whatever happens, it's not going to resolve itself quickly. I think we're all hoping that the current sort of lockdown that we're under will ease sooner rather than later. I know in Virginia, the governor's order is through June 10th. Now, I suppose he could always rescind that at any time he wanted to. But we've still got, over a month and a half to go. And that's assuming it doesn't get extended. Now, of course, we don't know, what tomorrow will hold, let alone a month or two from now during these crazy times. But I think we're in for a sort of a long event. This is, again, a marathon. I don't think things will go back to normal until social interaction goes back to normal. And I think under the best circumstances, we're looking at least through the rest of this year and probably past that until we get a more, I suppose, permanent solution to the health issues, to COVID-19. So that all sounds negative. I suppose it is. From an investing perspective, though, I can tell you I've not sold any of my investments. I haven't changed my asset allocation at all. But there are some things I'm going to be doing and some things you might want to think about when it comes to finances. So let's kind of get to that now. The first thing, before we get to actual investments, the very first thing I think is critical is your emergency fund. And, we know how important it is. We talk about having 3 to 6 months. Only you can assess your risk of losing your job. Some of you listening may have already lost your job. Others, may be in fear of losing your job. Some of you, if you're a nurse or a doctor, you've got full employment probably forever. But for everyone else, who knows? I think, we obviously had a first wave of unemployment that hit, retailers, the travel industry, and all that sort of thing, restaurants. That's gonna, and I think it already has started to create sort of a ripple effect through the economy, and it's going to end up impacting what I think of as sort of the second wave of unemployment. And I think that's just sort of reality. Only you can assess, though, your risk of losing your sources of income. But even if you're pretty confident that your job is secure, I think it's critical more now than ever that you have as strong a cash cushion as you can build up. I think the rules of thumb, throw them out the window. The days of saving $1,000 and then putting every other dime towards debt, that's just not going to work. I don't think it works in the best of times. I've never been a proponent of that approach, but in the current times, it really just shows you how much that kind of thinking can put you at risk. I suppose we can say, well, COVID-19 is a once in a lifetime event. Who could have expected it? Fair enough. I guess some people did, but I hear you. I certainly didn't. But we could say the same thing about the '08 and '09 crisis, right? We hadn't had something like that since maybe the Great Depression. So each event is different and maybe even unprecedented. But these unprecedented events happen every 5 to 10 to 15 years. So we really need to make sure we have as much liquidity as we can generate, as much emergency fund savings as we can. Now, what does that mean as a practical matter? Well, for example, when you get your stimulus check, if you can save it, you should save it. I know not everyone can, I get that. But if you can, you should. The other thing is, if you've been paying extra on your debts, if I were in that situation, I'd be scaling that back. I'd be making only the minimum payments. I'd be keeping up with those, assuming that I can. But I would be scaling those extra payments back so that I can conserve cash. The other thing I would do is go through what I've called and talked about in the podcast before, a money audit, which is really nothing more than going literally line item by line item and looking at every monthly bill that you have and asking, do I need this? Can I get rid of it? Now, in normal times, it's easy to say, no, I need my gym membership. I need 5 different streaming services. Actually, now maybe we need those more than ever. It's up to you. My point isn't to pick on any one kind of expense. That's obviously a personal decision. But I think it's critical that we go through each monthly bill that we have and ask, how can I reduce it? How can I even get rid of it, if at all possible? That is now more important than ever, and it will help you to save even more and hopefully, even in a difficult time, build up an emergency fund. Again, if 3 months from now, 6 months from now, everything's back to normal, terrific. And then you can take that money and then put it down on paying down debt if that's what you choose to do, or investing it, or maybe no, you want a bigger emergency fund going forward. But you'll have that option. So that's the kinds of things that we're doing. We're looking at our monthly expenses, reducing them where we can. Actually, as just a matter of being at home all the time now, our monthly expenses have gone down dramatically. And I didn't think we spent that much money to begin with. We don't go out to eat a lot. We don't go out a lot under normal circumstances, but it all adds up. So to the extent you can save on these items, now's the time to go through your budget, look at everything you spend and ask, how can I reduce it or maybe even eliminate it, and then save that money. Now, once we get to investments, I want to say that in my view, this is not what some people like to call a buying opportunity. The market drops by 10 or 20%, and you get these folks online that, say, okay, now it's a buying opportunity. Well, sometimes it is, but now I don't think so. Let me show you a couple of reasons why. On my screen is, this is the Shiller PE, which uses an inflation-adjusted 10-year period for earnings. You can see that it's currently at 26.44, and that's with a mean of 16.7. So even with the big drop in the market that we've seen and experienced over the last few weeks, we're still well above the average as measured by the Shiller PE. Now, even if we just look at the regular PE, and I can pull it up on the screen now, it's 20.33. The average dating back over 100 years is 15.78. So when we look at the market as a whole, it's really not cheap. In fact, it's still pretty significantly above the average. Now, I think one could make the argument that given our current interest rate environment, that the PE is probably reasonable at 20.33. And I would say in broad strokes, that's probably right. But certainly I wouldn't call this a buying opportunity. Now, you could look at individual stocks, whether it's in the airline industry, the oil industry now, maybe banking, that have been hit very hard. And you could look at their PEs and you could make an argument that it's a good buying opportunity. What I would say is they can get a lot worse. I'm not predicting that they will. I don't make my investment decisions based on a price prediction. I don't have some prediction about what the S&P 500 will look like at the end of the year. I just don't find that a meaningful way to invest. But I think we're not near the end of what we're going through now. So this idea that because prices have come down, and it wasn't that long ago, that we could see prices that were much higher, that this is now a buying opportunity, I think could be a pretty big mistake. And in fact, if I pull up my Apple stock app and just show you the S&P 500, and if we go back, say 6 months, we can see maybe even 3 months, we can see how much it's fallen. It was at a high of around 3,400. Then it went down to about 22, 37. And now it's around 2,800. So it's still well off its high. And I think that causes some people to say, hey, this is a buying opportunity. We can see just a month or two ago, it was way up here and now it's fallen. And so let's get in when it's cheap. The problem with that is that we're not anywhere near through the current crisis, and we have no idea which way the S&P 500 is going to go tomorrow, let alone in the next month or next year. But at the same time, we know that historically it's still expensive. So I haven't changed my asset allocation plan at all, but I don't at all think this is a buying opportunity. I think this is an opportunity to make sure you have plenty of cash to get you through the crisis. I wouldn't change your existing investments unless there was a good reason to. You shouldn't have invested money that you're going to need over the next 5 years anyway, and that's particularly true for retirees. But unless there's a good reason to, I've left my investments alone. But I'm not out spending the cash that we have on investments thinking this is a good buying opportunity. I think risking what you have so that you might get a good deal in the market in incredibly volatile and uncertain times is just not a great approach. Now, having said all that, I do think it's time to make sure you're well diversified. And I want to show you a couple of things in that regard. The first has to do with bonds. I've come to believe that the best bond allocation is roughly half of it in bonds that are protected in the event of unexpected inflation. That's basically TIPS, Treasury inflation protected securities, and the other half in U.S. government bonds. And here's the deal. As you probably know, with bonds, the biggest risk to a bond investor is inflation. You get locked in at an interest rate, and then inflation goes sky high, let's just assume, and current interest rates go up, and you're stuck with these low rate bonds. And so the idea of TIPS is, well, don't worry, you're protected. Think of it almost like a TIP is almost like a bond plus an insurance policy. And the insurance policy kicks in, if you will, if inflation goes up more than is expected. Of course, if it doesn't go up more than expected, you've sort of paid for this insurance policy and ended up not needing it. And how do you pay for the insurance policy in the case of a TIP? Through lower interest rates when you buy the bonds. So the idea behind roughly half your portfolio in TIPS and the other half, say, in treasuries is you don't know whether inflation is going to go up by more than expected. So just like we diversify across different kinds of equities, let's diversify across different kinds of bonds. We don't know what inflation will do, so we'll put half of our bond investment, bond portfolio in TIPS, and the other half in, say, treasuries. And so a good TIPS fund that I've invested in before is at Vanguard. This is ticker VAIPX. Now this is the Admiral shares, which, as you'll see, requires a minimum investment of $50,000. They have investor shares as well, and I think the minimum investment there is $3,000. And I think this is an excellent fund for a portion of your portfolio. I'm just clicking over to the portfolio and management tab to show you. They have an average duration of 7.9 years. What that means is if interest rates go down by 1%, the value of the fund will go up by approximately 7.9%. And if interest rates go up, the value will go down by 7.9%. That's generally what duration means for any bond fund. So this is a fund that I like. And then for treasuries, they have an intermediate term treasury index fund. It has a minimum investment of $3,000. Its duration, I think, is a little shorter. Yeah, its duration is 5.2 years. I think these two funds can be an excellent total bond portfolio, just these two funds alone. At times, I've owned the Vanguard Total Bond Index Fund, and it's a perfectly good fund as well. The one thing I don't like about it, and I'm showing you the portfolio screen, is in addition to treasuries, it owns bonds issued by companies. It's got some government-backed government mortgage-backed bonds. The problem is that those bonds and corporate bonds, when the markets go down and companies are struggling and real estate is struggling, those bonds can get hurt. And that's really not what we want in our bond portfolio. We want it to sort of protect us in bad times. Again, I still think this is a great fund, and I still have shares of it now, but I'm in the process of moving some of my bond portfolio more into the first two that I mentioned, TIPS and Treasuries. So that's the bond fund. On the equities side, and we're 70-30, 70% equities, I'm pretty much staying as I am, but the one thing that I would say is I think it's really important to have an international exposure. This is where I don't get comfortable having all of my equities in just U.S. stocks, which I've never done. And it's not that I think international companies will outperform U.S. companies. It's that I just don't know. I don't know, how the market's going to play out over the coming months and years. And so rather than trying to bet on one country or another, just like I'm diversifying with different kinds of bonds, I want to diversify with different kinds of equities. And so I have a good, healthy dose of both U.S. companies and international companies. And again, in my case, it's just through Vanguard index funds, which I think are, for the vast majority of people, the best way to go. The last thing I want to mention, and this kind of moves away from investing, and by the way, that's it. That's all I have on the investing front. I'm not making big changes in the asset allocation. I'm not making any. And I don't think most people should unless there's a good reason to. I'm staying well diversified across both U.S. and international companies on the equity side, diversifying on both TIPS and Treasuries. On the bond front, I'm making sure that we have a healthy emergency fund and getting rid of any unnecessary expenses I can. The only other thing that we're doing, and this, if you can do this, I think we should, and that is trying to figure out how we can help other people. In our case, my wife and I give to various charities, and when this COVID-19 hit, we normally give to charities in August. And the reason, by the way, we give to charities in August is because a lot of charities, their funding and their contributions go down in the summer months. People are traveling, they're on vacation. A lot of people donate at the end of the year for tax reasons. And so we give to a lot of charities that help particularly children. And in talking to them, we've just found that August and July can be difficult months. So that's when we normally give. Because of COVID-19, as you can imagine, contributions have gone way down and the charities we support were struggling. So we've been giving money to those charities during the COVID-19 crisis. I know not everyone can do that, and that's great, that's fine. But if you can, amidst trying to protect our own finances, important, absolutely, we ought to be thinking about how we can help others. And even if it's not financial, then the other thing, if you're healthy and you have the ability to help in your community, I've signed up for a couple of things within our community. Haven't done anything yet. I think one of the things I'm going to end up doing is helping get groceries and medication to the elderly in our community. So I'm signing up for that, and there's a background check. But I think, in this time, that's as important as taking care of ourselves. Again, I get that not everyone can do that. But if you can, I think it would go a long way to helping everyone get through this difficult time. So that's what I have for you on managing COVID-19. Some of you actually may be disappointed. You might have expected some radical thing. No, I don't. It's not radical. The radical stuff that you're reading online in terms of your finances are usually not good ideas. I think it's keep liquidity. Keep building an emergency fund if you can. Reduce your unnecessary spending, including extra payments on debt if you don't have to make them. Make sure your portfolio is well diversified on both the bond and equity side. And, if you can help others, do that as well. Hey, until next time, remember, the best thing money can buy is financial freedom.